Hey, Eric here from 5minuteinvesting.com, and welcome to this video about stock market investing for beginners. Now, I have been kind of watching a couple of stock market videos for beginners online on YouTube, and I found out they always talk about diversification and picking stocks and basically managing and balancing your portfolio. So I thought it might be interesting to actually do another video on what is even in the stock market and who are you competing against. Now, a lot of people think stock market is a zero-sum game, which is very popular among movies, because when you're buying, someone is selling, so then somehow people got the perception that it's a zero-sum game, but that is actually not the case. So to understand the stock market, just like any game, whether you're playing sports or chess, it's best to understand who is playing it and who are you playing against. So that's what this video is really about. Yeah, so the first type is called ETF funds, mutual funds, and pension funds. Now this is actually what the general public is the most familiar with. And these are regulated funds, and they have a lot of restrictions and a lot of rules. Like there's a restriction on how diversified the portfolio needs to be, and there's a restriction on whether they can use leverage or not, and most of the time they cannot use leverage. And their goal is not to beat the market. Their goal is actually to be as close to the market as possible, charge very little fees, maybe 0.5%, maybe 1%, and then they try to beat the market by 1 to 2%. That's really what the ETF funds and the pension funds are trying to do. And instead of earning a very high return, they actually aim to have a very stable return, a very consistent return, because they essentially want to eliminate all the volatility in the market and give the fund holders a very stable return. So for example, if you invest in an ETF fund, you would expect to make maybe 5 to 7% every single year, and it shouldn't range too much from that. So you wouldn't expect something like negative 10%. You know, that you shouldn't be expecting from an ETF fund or a pension fund. You know, for pension funds, this is a really long-term fund where you are funding the group of people who are retired, and you are also getting contributions from people who are working, and then through the difference between contributing and giving money to the elderly, you invest the money. And that's what really pension funds are all about. And they try to maintain a relatively consistent return, and they just want to grow with the market. And that's really the goal. So when you look at the information they have, they don't really have a lot of significant information advantage compared to everybody else. They might be able to attend earnings call, which the general public would not attend. They might have a Bloomberg terminal, so certain tools that allow them to get information faster. So when you are comparing between ETF funds, and later on we'll talk about this as well, to the general public, they'll have more information and faster information because of tools, because they get invited to earnings call, and that gives them a leg up compared with the general public. But when you compare ETF funds versus like hedge funds, then the advantage doesn't really exist. So if you are the general public, you'll be at a disadvantage when compared to the ETF funds / pension funds, because they have access to more information simply by paying for it. So, but when you compare to the other people in the markets, they don't really have a significant information advantage. Now, the second type that I actually want to cover is called robot investing. And I think this is quite a popular trend recently, like Wealthsimple or other robot investing strategies that are available to the public. Now, these are usually kind of like ETF funds type of investing strategies, where they try to be really safe. They try to normalize or stabilize the return, so you're getting a very consistent return, or at least you're as close to the market as possible, and they charge you a very small fee. And what they're claiming is that through using artificial intelligence, you can beat the market by 1 to 2%. So over time, that creates a significant difference. Is what they're trying to sell you. Now, when you're looking at robot investing, and you compare that to ETF funds, technically, you can say it's better or not. So there are arguments for both sides, because when you look at the return for robot investing, is really 1 to 2% higher than in ETF funds, and the transaction cost is lower, so the management fee might be lower. Like there might be a 0.25% management fee instead of a 1% management fee. So they try to run as lean as possible, and they try to kind of just tag along with the market. So if the market is going up 7%, they try to be 8% or 9%. But when you think about it, over the next 10 years, 1 to 2% difference will only add, in total of 10, 15% to your portfolio over 10 years. So that's 1 to 2% a year. So it's not really significant in a way that is life-changing to the general public. Like if you picked a ETF fund that is pretty much the same as the index and you choose robot investing, at the end of the day, you'll be plus or minus 10%, which can be just deviation, which can just be, in terms of statistics, fluctuation or volatility within the return itself. So in my mind, robot investing, ETF funds, and pension funds, they're all kind of in the same category, because the amounts of return they're getting and their goal is not exactly to beat the market significantly, but to simply follow it and be as lean as possible. And then one of the key concepts from these group of people is that they want a balanced portfolio across different sectors, across different companies. So when a certain sector is doing well, they'll take money out and put it into another sector. And it doesn't really apply to this group of individuals here. Yeah, it doesn't apply to this group of individuals here. Now, the third type, of people will be industry analysts. And when you're investing in the market, you really want to remember that there are people who are dedicating full time looking at an industry or looking at a specific stocks. So when you are investing in the market, you're really competing against some of the brightest people. For example, healthcare. There's going to be a ton of analysts that are just following certain pharmaceutical companies day in, day out. They pay attention to every earnings call, they get invited to it, they write reports for you. So whenever there is certain news or certain advantage where they can see it, they'll be investing first. So these people will invest first before the general public, because they pay attention to it, they're dedicating full time, and if you have a full-time job, you're not going to be able to beat these people unless you know how, and unless you have some industry knowledge. And when they write a report, they're going to distribute it to ETF funds, pension funds, and robot investing. Well, actually, it doesn't apply to this one because this is an AI. So ETF funds and pension funds. So the industry analysts will feed their reports to these funds, or maybe hedge funds as well, and they will be the second group of people that get the first-hand information. So by the time it gets released in news or Fox or CNN or whatnot, you're going to be the last person to know whatever they observed. So when you think about this dynamic, you understand why the general public is always a few steps behind in terms of the stock market. And when you're investing in the stock market, you really want to think, am I the last person to know? Like if you are the last person to know, there's really no advantage of you investing using a piece of news, using earnings release, because everybody here will know about it before you do. So you really want to think about what is your edge. Now, here I added a group of people called day traders. Now it's kind of interesting the way I think about day traders. So day traders focus on very, very short time frame. And robot investing, pension funds, ETF funds, and they usually focus on a long term. Industry analysts, depending on their kind, they might focus on long term, some focus on short term. But day traders, they focus on very, very short term. And when you think about it, they try to just capture small little price movements within the stock market on a very frequent basis. So their transaction cost is really high, and their goal is just to when the stock is ticking 2-3 times and they try to capture a profit. So when you think about it, let's say the fair market value of the stock is $1. Okay, this is what the true worth of the price. And right now the stock price is actually 90 cents. What the day traders will do will keep buying it until it's $1. And if it is over $1, like let's say $1.1, they will sell it. So it acts as a stabilizing mechanism. And this is why people say that the market is quite efficient, because you have a lot of day traders that are just looking for price inefficiencies, looking for very short-term arbitrage opportunities. So this gives people the impression that the stock market is efficient. But what happens when there's like a large distortion? What happens when there's a government policy that impacts the industry for 3 to 5 years? And whenever there's something like that, longer term distortions, the market itself will be inefficient. And that's when even day traders cannot stabilize those events. So day traders can come in and stabilize short events by trading heavily during certain times like earnings release. A lot of day traders pay attention to earnings release because there's a lot of volatility. So for example, a new IPO, day traders would come in and try to just take advantage of those high volatility period because a lot of people are paying attention to it, and the market will try to be either as efficient as possible, or the range will be so huge that any order will get triggered. Okay, good. So the next group of people is management. Now, for every company, there's 5 to 10 executives like CEO, CFO, CMO, CIO, CTO, whatever. And this group of people are super important because out of everyone here in the market, this group of people make the decision on how the company is going to grow, what the company is going to do, and this is the brain of the company. And if you understand how they think, this is one of the key ways to have an edge over industry analysts, over ETF funds, and over pension funds. Because if you understand how management thinks and where the company is going, then you'll be a few steps ahead of them. And I think that is very important. So, yeah. So management also trades the stock market, and they buy and they sell and they try to take profits when the stock price is high. And based on my experience, most of the time they are pretty rational. So when the stock price is too high, when management thinks the stock price is too high, they'll start selling. So you don't want to be buying when management is selling. And when they think the stock price is too low, they'll actually buy. So this is a very good indicator, and you definitely want to look into how management is thinking. And that's going to give you a leg up over these people. Now, the second last one is really hedge funds. And for hedge funds, their strategy can range a lot. And this is where the return exponentially increases. So on the right hand side, you have people that are just aiming to make average return of 4 to 7%, okay? But on this side, you actually have people that are making anywhere between 20% to 100% depending on the investment strategy. So for example, they might invest in the public market and use debt, and that will amplify their return significantly. And for hedge funds, I actually include private equity funds in here because sometimes private equity funds also invest in the market. Now, on the opposite side, you also have hedge funds that are like day traders, and these people have state-of-the-art servers, and they have state-of-the-art investing strategies that kind of take advantage of those small inefficiencies in the market by less than a second, like a millisecond. And there are a lot of famous companies like Citadel that have, or JP Morgan, Morgan Stanley, that have all these day trading strategies where they hire astrophysicists and develop algorithm to take advantage of these small movements. Yeah, so it's like day traders on steroids. That's why when you're looking at the short-term market, it's pretty efficient, and it's quite difficult for a new day trader like yourself, if you want to be a day trader, which I don't recommend, to come in and beat these hedge funds because they dedicate full time. They have better server access, faster internet connection, more strategies, and they have smarter minds, which are like PhDs with a physics degree or whatnot, or a mathematics degree, and trying to understand the wave patterns of the market. So when you're looking at trying to get an edge in this game, which is called a stock market, you really want to think about where you're going to play in this game. Like, are you going to try to beat these people because they're heavily regulated, they're slow, they don't move that fast, but then they have more information than you because they buy from industry analysts? Or are you trying to be a day trader and trying to beat hedge funds or seasoned day traders where they have the state-of-the-art servers, they are faster than you, they have better internet connection, they have more strategies? So when you are the general public, you really want to think about how do you play this game in a way that you can win. And the final group of people is really the general public. Now, the general public, for me, I define it as people who are not familiar with investing. Now, most of the time, their money will actually go to ETF funds and invest in the market, but sometimes they'll just invest based on a friend's recommendation. They'll invest based on news, like they heard something, or they'll invest because they like the company without doing much research. So you always get this group of people last, and you always get this group of people losing the most money. Now, they lose money too, but then when the general public loses a lot of money, what is really happening is the general public bought when it is high, and then the hedge funds sold, or the ETF funds sold, and the market went down, and then hedge funds bought again, and then the general market is like 2-3 steps behind these other funds. So this is really the stock market for beginners, and it's not it's not an even playing field. It's not a fair game because people try to get an advantage over each other all the time, and they pay money for it, they hire the best people for it. So when you are investing in a stock market, you really want to think, what is the edge, and do you have an edge over not everyone else, but over at least 60% of the market? So if you do your homework, you learn how to master investing, you know how to use stock options, and you aim for 30%, you know you should have an edge at least over some group of the people here, some of the groups here. So you will never get 100% dominance because someone will always know or be able to decipher the market just like you do. But you want to think, who are you having an edge on? Like, what kind of edge do you have, and who is like the last person? And if you don't know who's the last person, then chances are you are the last person to know. So that's pretty much it for this video, and this really gives you an overview of the stock market, the kind of players that are in it, and how competitive it is, and how unfair it is. And I think it's important to have this mindset before you go into learning stock market investing, because it's not easy. And it took me 8 years to figure it all out. So yeah, leave a comment below if you have any questions, and if you like the video, please share it.